Now, investment-based ratios. Again, we've talked about the PE ratio. We're now going to talk about something called the price-to-book ratio. And the price-to-book ratio is the price of the stock in the market divided by what's known as the book value per share. Now, to calculate book value per share, you'd first calculate the total book value of the company. And the total book value of the company is going to be the total assets of the company, this number right here, minus all the debt. Now, the debt of a company is the short-term debt plus the long-term debt. So if you take the total assets of the company and subtract out total debt, you have what's called the book value of the company. Now, analysts view the book value of a company as being the lowest price the company should ever sell for. So if this company's total assets were $400,000 and the debt was $200,000, they would tell you that the book value of the company was $200,000. Now, that means if you were going to buy the entire company and they offered to sell it to you for $200,000, that would be a good deal. Now, the reason they think this now is because total assets on a balance sheet are historical cost, not the current market value. If you can buy somebody's assets for what they paid for it 10, 15, 20 years ago, that's a really good deal. The debt, on the other hand, that's actually the debt that you owe to the bank or whoever the debt holders are. So you've got a very conservative estimate of asset value. You've got a market value of debt. And again, the difference between these two things, the total assets and the debt, that's called the book value of the company. And so this company's book value would be $200,000. If you divide that by the number of shares outstanding, again, outstanding meaning the number of shares that have actually sold to date to shareholders, if that was 10,000, then this company's book value would be $20. Their book value per share would be $20. Analysts view book value per share now as the lowest price the stock in the market should ever sell for. So if you could buy this stock for less than $20 a share, you should buy it. The analysts will tell you that's a good deal. The price to book ratio, the price of the stock in the market divided by the book value per share, for this company, that would turn out to be 5 times. 5 times now means that the price of the stock in the market is 5 times the book value per share. Price to book now is an indication of what the market feels is the value of the company. The greater the price to book ratio, the greater the market's opinion is as to the value of the company. The lower the price to book ratio, the lower the market's opinion as to the value of the company. So what you'd like to do as an investor now is buy a stock whose price to book value is low and then have it go up. That's the same thing, by the way, as buying low and selling high. But nonetheless, this is called the price to book ratio, and it's an indicator of value in the market. The greater the price to book ratio is, the greater the market's opinion as to the value of the company. The lower it is now, the lower the market's opinion, the lesser the market's opinion is as to the value of the